Hello and welcome to the Global View. Safe to say today a lot of the focus will be on the United States with the U.S. election looming. I'm Nadine Blaney. Markets pretty jittery ahead of the U.S. election. Utilities were the weakest S&P performers, energy leading the gainers. By the end of the session, all three indices were well into negative territory. The Russell 2000 rose, though, as falling yields supported small-cap stocks, and the CBOE's fear gauge, the VIX, was above its long-term average of 19.46. Some of the so-called Trump trades unwound after a poll showed Harris as leading in Iowa. The presidential candidates are both scrambling for an edge, with polls showing the race is extremely close. It could take days to determine the victor. The unwind of the Trump trade sparked a drop in the U.S. dollar. 10-year treasury note was off about 4 basis points to 4.325% after initially dropping as much as 10 basis points. The 10-year yield had fallen for 5 straight months before surging more than 47 basis points in October. Bitcoin fell. Trump is viewed as being more favorable toward cryptocurrencies than Kamala Harris. The Trump Media and Technology Group was actually up 12%, bouncing back from early losses of nearly 6%. In other news, Nvidia rose on inclusion in the S&P Dow Jones indices. It will replace Intel. On the earnings front, Marriott lost after cutting its 2024 profit forecast on weak domestic travel in the U.S. and China. And Constellation Energy was the worst performer on the S&P 500, slumping close to 13% after a federal commission rejected an agreement to increase the power capacity of an Amazon data center connected directly to Talen Energy's nuclear power plant in Pennsylvania. So I just thought I'd give you some perspective. So this is apart from the election, according to Ryan Detrick, who is a data guy and worth a follow on X if you're still on the platform. 2024, one of the better first 10 months ever for stocks, when the S&P 500 is up more than 17.5% year to date going into November, like it is this year. Returns for the rest of the year have been very strong, higher in 12 of the 14 Novembers, and in December up 11 of 14 times, never lower in the final 2 months of the year. All right, but of course, the election complicating factors this time around. Let's get a view on how markets are reacting to whatever will happen in the coming days. Steve Sosnick, Interactive Brokers, is joining me now live. Steve, good morning, good evening to you there. The result on an IFED right now, going into the election results, has the market itself voted on the election yet?
Good morning, Nadine. No, it really hasn't voted yet. And I don't think it's going to vote, actually. I think it's going to react to the election. But the problem here we have is the race is so tight. It's really 50-50 in the polls. Yeah, some of the prediction markets are pointing a little bit in favor of the former president over the current vice president. But for the most part, it's too close to call. I mean, again, if you're running a multi-billion-dollar portfolio, you're not going to make too many choices based upon, let's say 55-45 chances, which is still essentially a coin flip. So this is the situation that we're dealing with. And I think what you're going to see is more of a question of who wins the presidential race, and almost more importantly, who wins the House and the Senate, because market, I think, is really not going to like if one party takes them all, regardless of which party it is. But that's kind of why you saw a lot of the Trump trades fade a little bit, because it's not clear. It's not clear who's going to win and how this is going to work out. And hopefully we'll find out, tomorrow night. But probably you guys won't know until Thursday morning, would be my guess.
Okay, so what markets are you watching to give you some sense of where things will head once the dust does settle, once we know the makeup of the House? And will it be options? Will it be the VIX? Will it be gold? Where do we go to?
The first place I'm going to look is the Treasury market, because Treasury traders are incredibly focused on, this is what they do. It's really basically, they are laser focused on, on potential inflation, potential credit, which really doesn't come into play very often, but may if you have one party that that seems like it's going to just spend, 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 and quite frankly, that could be applied in different ways to either party. And so you don't really have a good sense until you see what the bond market's doing. I think in the short term, Harris is perceived as a bit more treasury market friendly than Trump because his tariff policies are sort of they're sort of scattershot at this point. And I think, if he really intends to cut income taxes further while replacing that income with tariffs, most economists say that won't work. So that would be one of the things I would be watching. I would, of course, look for VIX. I would look at some of the volatility indices. One stock to keep an eye on, of course, is DJT, which is essentially just a leveraged bet on the former president's chances. We saw that go from like 12 to 50 back to like 25, and now it was about 30-ish. And so that would be one to watch, although that probably gets limited because of overnight trading rules up or down. To some extent oil, but I don't know that either candidate is particular. Trump is perceived as more energy friendly, so you might see the price of oil head down a little bit, but I don't think it's going to be that meaningful for it. And so that's really, and then just look at S&P futures. Although keep bearing in mind that in 2016 the S&P futures were perhaps the worst indicator because they originally sank when it looked like Trump had beat Clinton, and then reversed strongly once the markets opened. So there's no foolproof way to look at it. But those are going to be my tells tomorrow night.
Yeah. Okay. Now, on bonds, on treasuries, I've had a number of people explain that in their view, Trump wins, yields go past 5% for the 10-year. Following that, you get an equity market correction, 10 to 15%. Is that how is that how the bond market will work to you in a Trump victory?
Very possibly. I think equities, I think in general, he's perceived as being equity market friendly, but not if the bond market really doesn't cooperate. That's where the problem would come in. On the flip side, depending on how the House and the Senate shake out vis-a-vis the presidency, a Harris victory combined with Democrats controlling the Congress as well, you might start to see some tax selling brought forward. Normally you don't want to pay taxes in the current year, so you'll wait till December 31st, after December 31st, to take profits. You take your losses early. If there's the perception that the capital gains rate is going to return to the pre-2017 levels, well, then you may start to see some people bring some of the, if they've been on the fence about selling some stocks, they may bring some of that selling forward, actually selling winners rather than losers. So it's a very fluid situation. I would like to think that the bond market stays in control. I'd like to think that, just in general, we manage to stay in control, and hopefully that's how we all pan out.
When it comes to what has been the main driver of markets this year, so the AI narrative, of course, we had some flesh put on the bones of that last week when we heard from mega cap tech and the investments that they're still making, when they're expecting to see some of the returns come through. But is either presidential candidate more favorable when it comes to, it's a crude way of putting it, but the chip makers, that AI trade, because we do have the specter of increased tensions with China as well coming through under one of the potential presidential candidates?
That's a great question, Nadine, because it's not clear who would be better or worse at this. Kamala Harris basically comes out of San Francisco, as does most of the high tech industry. So she's known a lot of these players for years. They've been the ones backing her whole ascent in many cases. On the flip side, you do have a lot of tech, people backing Trump. Most notably Elon Musk, who's thrown hundreds of millions of dollars into the effort. So, at some level, it almost implies that Elon Musk becomes Mr. AI in a situation like that. And so draw your own conclusions there. I think that, I think basically in general, we've seen what the last earnings reports showed us was that the narrative is somewhat changing, and that's not and it's irregardless of politics. It's basically a matter of at some point, somebody's going to have to start making money from this stuff besides the chip makers, because obviously Nvidia and friends are making boatloads of money. Microsoft, Meta, Amazon, et cetera, they're all spending gobs of money to build out their AI. That's what's lining the pockets of Nvidia and AMD and such like that. But at some point, they have to start making money from it. And the way they're going to start making money from it is when their customers actually find that it's got some value to them and start to pay for it. And I don't know that we're there yet. And I think people are getting a little more impatient about that. I think that's kind of why neither Microsoft nor Meta really, why they lost traction despite beating on earnings. We've seen the movie before with Meta, where they spent all that money on the metaverse and got nothing out of it. I don't know that that's going to be the case with AI. I think that's probably a bit much. But at some point, investors, show me the money, because at some point, somebody's got to start making money from this thing other than the people who are, the proverbial pick and shovel manufacturers for the gold rush.
Yeah, interesting. All right, it wouldn't be a conversation without at least touching upon the Fed, obviously very much overshadowed by what's coming prior, but 25 basis points seems baked in. The Fed likely wouldn't do anything to upset the apple cart. I mean, first of all, they need to cut if they did a 50 basis points last time around. And the data, you would think, still doesn't justify any significant, backup cut of 50 basis points, correct?
Absolutely correct on the 50 basis points. I think in general, this is not a Fed that likes to surprise markets, as you noted. And so 25 basis points being essentially largely baked in, it's probably where the Fed goes. I will argue that they may start to throw a little bit of cold water on the idea of future rate cuts, maybe not for December, because that's also largely baked in. And depend, remember, the Fed may be having this meeting when we have no idea who's going to be running the country for the next 4 years. And so my guess is they're not going to do too much in either direction. That'll move the markets either way. They're going to try to avoid that. But I do think that some of the economic reports don't really justify aggressive rate cutting. And that's going to be really the key to think about going forward, because if earnings are this good and the labor market is generally good, not, Friday's numbers were clearly, affected by hurricanes and strikes, which is why ADP, had a big gain of 200,000 plus jobs, which is, not survey data. That's actually people who process my paycheck, among other things. So they're using hard data. So it's telling me the labor market, I'm going to say the labor market's having, is not in the decline. It's sort of in, the equivalent of disinflation. It's slowing, but it's not, the rate of growth is slowing, but the market isn't actually shrinking. And so at some point, you have to reckon with, where does the Fed really think the neutral rate of interest is? Where do they really want to end up? And they haven't been particularly clear on that. I don't know that we're going to get a lot of clarity on that at the next Fed meeting, unless we have some clarity as to what direction the country is going to be going in.
Oh boy. Okay. Well, big questions. Not able to answer them today. We'll talk about it all soon, Steve, perhaps next week. Thanks for joining us.
Thanks, Nadine. Take care. Have a great day.
Good luck over there. Steve Sosnick there from International Interactive Brokers. Okay, so we've got a lot coming today here locally. We're expecting to see a dip at the open. Oil prices climb nearly 3% on OPEC Plus's decision for a month's delay in plans to increase output. Gold prices edged up on that U.S. election uncertainty. Copper rose, iron ore rose. Markets are waiting. A key meeting of top leadership in China for cues on policy stimulus. And we do have the RBA meeting today. So, yeah, we will get you across it all. The open starts next.